There may be some signs out there today that a leverage problem is starting to creep its way into the equity markets. And in this video today, I want to bring you up to speed on, first of all, what role leverage plays in investing, where we're at today, sort of do a snapshot so you can assess if in fact this is a developing problem. We're going to look at some people who support that argument and some people who don't. I'm also going to share just in general some thoughts that I have about leveraging, and so you can help determine who it's appropriate for, the types of things that you might want to do with leverage. That's what we're going to cover off in today's video. I want to start though with where we are today, and without question, we are at a highly levered situation in the equity markets. In Canada here, IROC, the Investment Industry Regulatory Organization of Canada, shows that we are at an all-time high with margin debt. As this chart shows, as we stand today, there is more than $30 billion in margin debt invested in the TSX. This is margin debt only. It doesn't even include home equity line of credits, mortgage refinance, etc. That's another $18 billion as of today invested in Canada. In the US, south of the border, margin debt, we look at the S&P 500, it's also at an all-time high of just over $900 billion. So both here in Canada and south of the border in the US, leverage is at an all-time high for investment purposes. I received a comment from a viewer I'd like to share with you named James, and James asked this question. He said, "I'm curious on expanding your thoughts on leverage. I chose to leverage heavy early in the pandemic by buying the TSX 60 top dividend payers and CPX and a couple of REITs. Today, that portion of my portfolio delivers almost $20,000 in annual dividends and is up a net 48%. At this point, I have significant capital gains. So, do I delever or ride out the near term where I'm likely to keep receiving my dividends but possibly see a significant reduction in my 48% gain? I expect to retire in 6 years and have always thought I would carry this leveraged part of my portfolio into retirement so long as the dividends and investment tax credit outweigh the interest costs." I thank James for this great question. And these are the types of questions that we answer virtually every day in our Investing Academy, whether it's for students or whether it's for members of our private membership group. These are the types of issues that people grapple with all the time. If you are interested in learning more about our Investing Academy, that will be, as always, in the first link below. Now let's look at James's situation in a little bit more detail. And I'll say at the outset, obviously, I don't know James. I don't know all of the rest of your circumstances, so I can't specifically give you advice on this, but we can talk in general about the issues you have to grapple with as a leveraged investor, and hopefully it'll give you some direction or some ideas as to the things that you need to consider. I would say what James is dealing with here is a classic dilemma. And most obviously, there are two very conflicting objectives that he has. Number one is he's using the portfolio to generate income. And as he said, he's generating around $20,000 a year right now in income and cash flow from this portfolio, which is very attractive to him. Conflict that with the objective of the capital growth. So he's worried, perhaps, or he's considering, should I take my profits on the 48% growth and lock in these gains, at which point he would mitigate or eliminate the downside risk, but he would also remove that cash flow. So this is part of that of the decision making that an investor has to make at all time. And it does come down to your specific circumstances. James does note that he's 6 years away from retirement, and we will talk more about that a little bit later in this talk because that does come into play as far as what he should be considering. I will say, just from the outset, leveraging is risky. And I know a lot of people who are levered are going to say, that's hogwash, and as long as you know what you're doing, it's fine. There is a reason that when you open a margin account or you take out an investment loan, and usually with dealerships on a regular basis, perhaps annually, you need to revisit your leverage situation. That's there because it's risky. It doesn't matter how you cut it. Risk, though, is subjective, I guess you could say to some degree. It's a perspective of where you think the markets are at, some other factors. I'm going to look today at what I would say is a growing concern out there in the market. If we look back at the chart, we see that leverage has been growing regularly. So what problem might this present? A couple of people who are quite well known in the industry. Let's start off with a tweet that Michael Burry sent back in February. And he said, speculative stock bubbles ultimately see the gamblers take on too much debt. The market is dancing on a knife's edge. Mohammed Al-Arian, who is the chief economic advisor at Allianz SE, says, I am concerned about the growing leverage. It is part of a more general phenomenon of excessive and, in some cases, irresponsible risk-taking enabled by a prolonged period of ultra-loose financial conditions. Both of these experts in their field are concerned that the sharp growth in leveraged investing in margin debt could be a precursor to a market correction. I mean, we'll just call it what it is. If we look back in history as a guide, I want to show you a chart here that goes back roughly 25 years. And if we look at the red line, starting at the left axis, it shows the increase in the volume or in the level of debt, starting at just under $200 billion back in 1997. We do see a sharp increase leading up to, yes, the tech crash, which started back in 2000. You can see the blue line is the S&P 500, and there's a strong correlation between when the margin debt peaks out with the S&P 500 performance. Once the market recovered, we go back up to the next sharp increase, which takes us to 2007. Of course, we all know that that was the precursor to the big credit crisis that we had through 2007, 8, and 9, early 2009. And again, there's a strong correlation between increased margin debt and market overperformance, or ultimately underperformance. Now, since 2009, so we're going back a long ways now, the markets have continued to rise for the most part, as has the margin debt. There was a pullback when the margin debt peaked out in 2018, pulled back, and here we are now in October of 2021 with, as I mentioned, just over $900 billion in margin debt. We also see the S&P 500 at all-time highs. If you look specifically at these two scenarios, you would be right to think, is there something I need to be concerned about? Well, you should always be concerned as an equity investor, however, specifically related to leverage here. A contrary view to that is made by an analyst named John Schlegel from JP Morgan Chase. And he recently said, in fact, I believe on September the 27th, he said, while there are many potential reasons one could cite for market condition, the level and changes in margin debt do not appear to be setting up for extreme market drawdowns like we saw in 2000 and 2007. He goes on to say, over the past 12 months, margin debt has climbed 41%. While that's above the 29% gain seen in the S&P 500, it's not totally untethered from the slope of equities. For context, during the past market tops, margin loan growth outpaced share gains by twofold in 2007 and almost 4 times in 2000. So Schlegel is saying that yes, there are always reasons that we might be concerned about the markets being overheated right now, but he doesn't see the rise in market debt as being one of those things that necessarily points to an imminent drop in the market. So where are we? Do we have too much debt? Do we not, are we okay with the debt? We see some very smart people with opposing views in this regard. And I guess that's always the way the markets work. Now, regardless of which side of that argument or that debate that you were sitting on, I'd like to take a few minutes and talk about the suitability of investing, or leveraged investing in the first place. So what would be the investment profile of someone who would be considering this? A few traits that just pop out to me that are critical if you are going to borrow money to invest. Number one, it will help if you've had experience in the markets. If you're new to the markets and you've never gone through an extended period or even a complete business cycle, having experience will give you a lot of insight, and it's something that you probably should have in order to leverage successfully. Obviously, being knowledgeable about the markets in general, but also how leverage works is important. You also need to have appetite for risk. If you are a risk-averse investor, it probably goes without saying that you shouldn't be borrowing money because that just increases the risk of investments in the first place. Probably the most important thing that you need to be aware of if you're going to leverage or if you're going to borrow to invest is that you need to be in a very stable financial situation from the start of the whole scenario. Some of those things you want to look for is, can you service the debt that you take on if you're leveraging from other cash flows? A lot of people, and I don't think in James's case, he didn't specifically say that the dividend income that he is earning is paying for the interest on the debt that he has, the leveraged amount. However, in many cases, that's the strategy people embark on is, I'll make enough money to pay for the debt. You need to be able to to invest successfully in this manner, you need to be able to have other sources of cash flow or other sources of resources that you can take to pay the debt, to pay the regular interest rate or the interest payments on that debt. For example, what is your salary like? Do you have sufficient salary to pay that debt if, for example, dividends are stopped from the investments that you have that you're relying on? Do you have a cash reserve? It's very possible you may have some money put aside that you can draw on if you are wanting to add to service those debt payments. Any other sources of cash that you can use in the event that the investment itself goes bad, and you still need to pay those interest payments, obviously. Another thing that you really need to consider is what is your total debt level? So if you have no other debt and your only obligation here is a leveraged investment, well, that may be a scenario, that may be a situation that allows you to do that. You have to look at what your total monthly debt service is. This is just like any other debt that you own. You own an asset or you have an asset that you have a liability against. You need to be able to make sure that you can service that debt on a monthly basis, all encompassing. Another thing that you might not necessarily think of that you should think of is, what about other lost opportunities? And an example would be if you're in the market, for example, to buy, or you're anticipating at some point in the future, you may want to take out another loan, for example, to buy a house or to buy a car or to buy a vacation property. This debt that you incur as a leveraged investment will count towards your outstanding debt. And it's quite possible that a bank or an institution that you go to lend you, asking to lend you money, will not lend you because they're factoring in that you have too much debt overall. So even though they're definitely not related directly, that will be a factor when you're going to borrow more or take on more debt in the future. So that's something that if that's in your cards, you need to be aware of if you're considering whether you should take on debt for a situation like this. A couple of conditions, or a few conditions, I think that need to be in place if you're going to be taking on an investment, leveraged investment strategy, is it should be long-term. That is subjective. Some people would say 5 years is long-term. Some people would look at a 20-year time period. Regardless, if this is a short-term strategy, there is an inherent amount of risk if you're trying to just capitalize on a market pullback and then your expectation is that very shortly you're going to sell the investments and go out. You do need to have a long-term strategy right from the outset. Also, it's prudent to have a diversified portfolio. You shouldn't borrow money, in my opinion, and buy an asset. You're really hot on a stock and you want to borrow, you want to buy it. You don't have the money today. You might want to borrow the money to buy that. You do need to have security in that portfolio because it is the asset that is protecting, that is collateral against the loan. So you do need to have protection there, and that comes in most cases through diversification. Generally speaking, rule of thumb, if you're younger, that's better than being older. For example, if you're near retirement, and James did mention that he's about 6 years from retirement. So that is something you need to factor in. It doesn't mean that if you're closer to retirement or if you're in your late 40s, mid 50s that you can't do it, because your investment horizon still can be longer. But a big thing you need to consider, and it kind of cycles back to what I just spoke about, if your cash flow, if you're servicing the debt from your cash flow from a paycheck, if that paycheck is going to stop and if that reserve goes away, then that would be sort of a scenario or a condition that you might want to say that this might not be a good strategy for you. A couple other quick ones. Obviously, interest rates are applicable. We're in a low interest rate environment right now, so money is cheap, as I said at the outset. So it's you can borrow more money for a lower cost, and that does entice some people to take that step when they maybe otherwise shouldn't. I can get more return than I can off the interest rate, but all of these interest rates that you pay on these mortgage debts, for the most part, I would say, are going to be floating rates. So if interest rates do spike up, obviously those payments are going to go along with that. And finally, I would say your marginal tax rate does matter. On a non-registered investment debt, the interest that you pay would be tax deductible against other forms of interest, other forms of income rather. So if you're in a high marginal tax rate, you will get more bang for the buck there. If you're in a low marginal tax rate, you can still make those deductions against other income, but there may be limited advantage. I wouldn't use that as the deciding factor on whether this would be an appropriate strategy for you or not, but it's certainly one that you do need to consider. Now, going back to James's scenario, he specifically mentioned that he borrowed in a down market. He borrowed in March of 2020. Now, nobody knew at that time that that was the bottom, but he probably did his research and said it looks like this might be an opportune time to borrow, and he was right. In March of 2020, that's when the market bottomed out. So he borrowed then, and it's the best time to borrow to invest is when the markets are low. Now, history shows that people, in fact, do the exact opposite from that on a regular basis. If we look at this next chart, and this is going to show the yearly change in margin debt on the S&P 500. If we look back to 1999 to that first spike in the blue line, you will notice that there is a purple line, a purple bar that corresponds with that. Now, the purple bar is shown by a bear market with a decline of at least 20% in the S&P 500. So leading up to the bear market, we saw an increase in the yearly change of margin debt. Interestingly, as soon as the market started to drop, and of course they dropped sharply back then, we saw a dramatic decrease in the yearly change, or a huge drop in people taking money or deleveraging during that time. Once the market stabilized, we then saw an increase again up until 2007-ish. Again, I don't think coincidentally, right before we saw the big credit crisis and the market drop again through that time period through to early 2009. There's been a lot of choppiness since then, but where we see ourselves today in October of 2021, we'll see that yearly change again quite large. Now, does this necessarily indicate that we are going to see another correction like we saw back in 2000 and 2009? That's not necessarily the case, but it is something to be aware of. So, is borrowing to invest either now, when I've identified at the outset of this video some of the concerns that are out there today with the high level of margin debt, or just in general, is this a good, solid investment strategy? It depends. It's suitable for some people if all of those conditions I talked about are in place. I would say that for most people, leveraged investing is not suitable. You do, regardless, need to understand your risk, factor in your experience, and you will make a determination based on that. But for most, it's probably better to avoid this part of the investing world in general. Just to wrap up James' question, we went back to the start of the video. He needs, I would suggest, to clarify what his objectives are. He talked about, as I said, those two conflicting objectives. One is, I love the income I'm getting in, but I'm a little bit nervous because I've made a good gain on this, and do I risk giving all those gains back? Depends on what your needs are. Now, I talked about time horizon as well, and James specifically talked about being 6 years from retirement. That is a factor. Long-term time horizon is generally better if you're an equity or a leveraged investor. But if James is, I'm just going to say, let's say he's 55 years old right now, retiring at 60 or 61. He still has a reasonable investment horizon ahead of him. The day that you retire, you don't necessarily have to sell everything and go back to the bottom line or to square one. So if he happens to time things inappropriately, he decides to ride it out, and the markets work against him in the meantime, as long as he has those other factors in place where he can still service the debt. For example, just basically I said, look at your overall experience, your overall financial picture. That would be a major factor. And lastly, I would say what we don't get from James's question is how much of his big overall financial picture is this? What percentage of his assets, what percentage of his income come from this strategy? If his entire cash flow is reliant upon this portfolio, that would be one thing. If he has $5 million tucked away somewhere else that he will be relying on for income, if all else hits the fan, then this might be this is a smaller chunk of that overall percentage, so it might sway in favor of him making a decision to do this. I would like to know if you personally have ever borrowed to invest. I know over the years I have at times. And my experiences have generally been good, but most of my investing career I have not been leveraged, but there have been times where I have. If you've had an experience, is it a good experience where you've capitalized like James has, or is it a bad experience where you took a hit? Or do you know of other people who's had experiences? Because if you share that information with us in this discussion today, it will really provide depth to the whole question that James had, and I'd love to be able to help him out with some other personal experience as well. I will wrap up this talk today. Hope it's provided you with good information as to what you might need to know if you're considering leverage as an investment strategy. As always, I mentioned earlier in the video, I'll remind you again, the first link in the video below is for our Investing Academy. And these are the types of scenarios that all types of people have to deal with on a regular basis. And members in our Discord chat as part of the community ask questions like this all the time. Some of our students who are going through the actual course material, these types of dilemmas are covered in material like that. So if that's something you're interested in, please click on the first link below. As always, if you enjoyed the video, if you found value to the video, I really would appreciate a thumbs up on that. If you feel like you want to share the video with someone else, I really appreciate that as well. I do thank you so much for watching the video, and I look forward to seeing you in the next video.